In this lesson, we're going to discuss the mechanics of a calendar spread and the convention used for Bitcoin futures calendar spreads. The majority of futures positions held by speculators are offset before final expiration. Some professional traders might allow their position to expire. In the case of Bitcoin futures, an expiring position would settle to cash according to the Bitcoin reference rate, or BRR. Additionally, some market participants may wish to extend their positions in a contract. The strategy that allows them to extend a futures contract from one expiration to the next is referred to as rolling the futures, or rolling forward. This type of transaction is called a calendar spread. A calendar spread allows a trader to trade out one expiring contract and into a deferred contract. By executing a calendar spread, a trader's Bitcoin futures position can be extended into the future by one or more months depending on which deferred contract they roll into. Let's take a closer look at how investors can roll their Bitcoin futures forward using calendar spreads. Here is a view of 4 active Bitcoin futures contract months. There are always 2 serial expirations and 2 quarterly expirations. January and February futures are listed along with March and June expirations. Let's assume a large investor is long 50 January 2018 Bitcoin futures contracts. The portfolio manager wants to extend his long Bitcoin exposure beyond January expiration. He enters a calendar spread order to roll his contracts forward. In the case of Bitcoin, the investor's FCM would sell 50 January futures, contract code BTCF8, and simultaneously buy 50 March Bitcoin futures, contract code BTCH8. Starting with an existing long position in January Bitcoin futures, then selling the Jan futures and buying March Bitcoin futures results in an offsetting position, or net zero position in January, leaving the trader with a long position of 50 March Bitcoin futures contracts. The trader has essentially moved his position from January to March. While the investor chose to roll into March futures, the investor could also have rolled into the February or June Bitcoin futures contracts, depending on his time frame, relative pricing for each contract month, and outlook for the price of Bitcoin. Certain futures contract spreads carry different quoting conventions. For example, stock index futures and treasury futures have completely opposite conventions for buying and selling calendar spreads during the roll process. Bitcoin futures follow the same convention as stock index futures, in that buying the spread means buying the deferred contract and selling the nearby. So, in this example, the pension investor buys the deferred contract, March, and sells the nearby, January. This investor is buying the calendar spread. The ticker convention would look as follows. BTC Jan 18 versus BTC March 18 is the Jan 18 March 18 spread. Buying the spread would be buying the March, selling the January contract. The price of the spread trade is the price of the deferred expiration less the price of the nearby expiration. After the spread trade is completed, the price of the 2 contracts will be determined using the following convention. Nearby contract is priced at the previous day's settlement price, while the deferred contract is priced at the front leg previous day settlement price plus the spread price. For example, if the Bitcoin Jan 18 March 18 spread was bought for a price of 130, after the spread trade is executed, the January contract will trade at yesterday's settlement of 14,975. While the March contract will trade at 15,105, which is the front leg price 14,975 plus spread price of 130. As of early January 2018, each deferred futures contract in Bitcoin futures trades at successively higher prices. This is known as contango. Hence, the spreads are positive as of now, but this could change at any time. In fact, they could go negative. Given that Bitcoin futures are new and carry relatively high volatility, it is important for investors, large and small, to be aware of the different ways they can manage their futures position.